Part 2, Chapter 9, KISO, Intermediate Accounting, 16th edition. Now we're going to look at the gross profit and retail method. And these are used to estimate inventories. Doesn't mean we don't do a physical count, but during the year, these methods are used. Retail method, particularly for retail businesses, can be used for financial reporting purposes. Gross profit, no, it can only be used for like insurance, or if you want a quick estimate, that's the only time you can use that method. Okay, again, we have two methods that we can use for estimating any inventory. We have the gross profit method, can be used for financial reporting because it cannot be used for financial statement reporting. GAAP requires a physical inventory. It assumes there's one gross margin for all goods. So this might be good if you had like a fire and you're trying to figure out how much the insurance company should pay you. The other method is called the retail method, and it's used by retailers to value inventory without a physical count by converting retail prices to cost. It can be used for financial reporting purposes, but you still have to do a physical inventory at year-end. Okay, gross profit method. To do the gross profit method, you need to have the gross profit on sales. If you're given a problem that instead gives you the gross profit on cost, so pay attention when you're doing your homework. What you need to do is do this formula. You're going to have to take the percentage of the markup on cost divided by 100% plus the percentage of the markup to convert it to gross profit on sales. So, for example, if you are given 25% gross profit on cost, to convert it to the gross profit on sales, you would take the 25 divided by 1.25, which would give you 20% of gross profit on sales, and that's the number you would use when you're doing the gross profit method. All right, so here we have an example, and in this example, they're telling us that we don't have to do a conversion because this is based on net selling price. And now we can do our gross profit method. And the key to this one, just put it in the format. Just take a piece of paper and write down this format, and these are really easy to do. Okay, so we set up the information. We always start with the beginning inventory. We take our purchases less our returns and allowances, and now we have goods available for sale. Now what we're going to do is figure out our cost of goods sold. So we're going to take our sales minus our returns and allowances, and we would also subtract out sales discounts if they had them, because we want net sales. Then what we're going to do is take the net sales times 35%, which was our profit margin, to get our profit margin in dollars. We're going to subtract that to get our cost of goods sold. We're going to subtract that from goods available for sale, and that's going to give us our ending inventory. Except in this case, we have to take out goods on hand at a value, a cost of $19,500, because we're going to only take 65% of that $30,000. And we're going to subtract out the damaged inventory salvage value. So for the fire loss, we would be able to claim $58,250. Now, the retail method. When we do the retail method, there's actually a number of versions here. One, and it all has to do with when you adjust for markups and markdowns. Now, the conventional method. You compute the cost to retail ratio before markdowns. For the LIFO method, you're going to compute the cost to retail ratio after markups and markdowns. The cost to retail ratio is only used for the layer of additional inventory for the current year when you're doing LIFO. So that one's a little more complicated. So now let's look at a problem. Okay, here is our problem. We began operations in 2017. There was no markup, markdowns, Inventory pretty much reflects what was going on. So now we're in the next year and we're at the end of the year, and now what we need to do is we need to figure out what is the value of our ending inventory using the retail and the LIFO method. But we have to have all this information to do that. So let's start with the retail method. What we're going to do is we're going to take our inventory, which we had at cost and retail. Then we're going to take our net purchases minus freight in to get our purchases at cost, and it gave us the value at retail. So we don't worry about the freight in for the retail one. Okay, now what we're going to do is add in our markups. And now these numbers right here are what we're going to use to come up with our ratio. Now we're going to take our sales revenue minus the markdowns minus the theft to get our sales at retail. We're going to subtract that from total cost of goods available for sale at retail to get our ending inventory at retail. We're going to take that times the 80,300 divided by the 110, and that gives us 73%. So we're saying that the ending inventory at cost is going to be 19,272 using the conventional retail method. Now, the difference between this and LIFO is how you get what you use to get this ratio right here. So now what we're going to do is we're going to do LIFO, the LIFO retail method. Okay, we're going to again start with our net purchases. We're then going to add in our markups, subtract out our markdowns, and if you notice, with this one, we don't include beginning inventory. Now we can come up with a ratio associated with the current year. The current year, okay? So this is the percentage we're going to use to look at our layer for the inventory for 2018. So another big difference between this and the conventional method is when we come up with our percentage, we do not include beginning inventory. So now what we're going to do is we're going to say this is what it was at the beginning of the year. We're going to come up with ending inventory, which was we did before, but I thought I'd show you again how you did it. You take beginning inventory minus sales plus purchases. This is all at retail, plus markups minus markdowns minus theft gives us our 26,400. We subtract our beginning at retail so that we can get our layer at retail. We're going to take this times that 75% cost to sales ratio, which tells us what is the value at cost of our ending inventory for 2018. So our ending inventory under LIFO is going to be 18,800 at cost at year end using the LIFO retail method. So that is the end of this presentation, or part 2 of chapter 9. Thank you.